What's up, everybody? I am back with another edition of the Sunday Scaries Stock Talk podcast. But first, I'd like to thank my sponsor, Inverse, INVRS. It's a new social and collaborative investment research platform. Companies like Robinhood have increased the access to financial markets, but Inverse is trying to increase the access to high quality investment research and discussion. So anybody can get on it. It's completely free. Anybody like you or I can get on it, post anything you want, post all your financial content, financial research. It's a great platform. It's built around top-notch data and tools that you can analyze over 10,000 stocks and ETFs seamlessly and embedded into the platform. In the coming weeks, they do have a surprise for you. You'll be able to link your brokerage account and share your portfolio to maximize your credibility, along with access to clean your portfolio analytics and much, much more. I myself have been using Inverse for the past couple of weeks, and I am enjoying that experience. I'm looking forward to growing my following on there, and I even have a Green Candle investment group. So if you guys want to get in there and join my group, feel free to ping me on there, and you can join it, and we can share ideas back and forth in our own private and our public group, actually. So yeah, get on there and join me and come and share some of your investing ideas. And now into the show. I have a very, very special guest. I have Luka at Stock Owl. Luka, how you doing today?
Fine. Thank you, Brandon, for having me to this podcast. Yeah, everything is fine.
Yeah, it's great to have you on here. So, why don't you get started by telling us a little bit about yourself? So, how did you get started investing? Was it something that you kind of, you can look back from, like maybe your parents or, some influence that you had when you were younger or something along those lines that kind of, maybe gave you a little inclination towards investing? Or was it school and you just kind of found your way through that towards investing?
No, I was how to say. My parents was not much into investing at all, so it's something I learned by myself. But I was lucky because when I was like 17, almost just turned 18, I met one of my relatives. I mean, one cousin of mine who told me about trading. I don't remember how it happened, but I started to get curious about this story. People trade. What is trading? And as soon as I turned 18, I opened. I was in Italy back then, and it was not very easy to invest online. I mean, there was not much broker account. So I was lucky that I found a digital bank who give this possibility, and I started to invest as soon as I turned 18, which was 2001, 2002 approximately. So from that moment, I started trading, but was not very profitable at all. I mean, I just start to buy company without thinking, or also I was focused only on the Italian market because at the time this bank didn't give me possibility to invest in United States. So there was just some random buying and selling, and as you can imagine, it was quite a disaster. But it was the time when I started to learn about technical analysis and this kind of things. And for a while, after some major loss, I mean, was not a big loss, right? If I think about that right now, but at the time was big for me. I stopped. I said, no, trading is not for me. I need to get out of that. And I started to read more about fundamental analysis. So I got more oriented into bonds, honestly. So for a while, I was buying and selling, but in general, buying and holding corporate bonds. And after I switched to dividend investing mostly. So this was a path that spread around I don't know 5, 6, 10 year maximum, and from let's say 8 year I am focused on my strategy, and I have let's say I open my portfolio. I'm keeping increasing my portfolio. As soon as I have some money, I put inside, and up to now is going good. So I close my trading period, and it was not for me. And when people ask me about, and on time to time on social, when I do some live or stuff like that, they ask me about what about trading, and I try to close the subject because it's really something I decided not to do anymore. So this is how I started. I mean, it was in some way casual. It happened just because I heard about this story of trading. I had no idea what was, but after it became something, how to say, is part of my life, because I understand that I will not have a pension when I will retire, because I'm working abroad from my country. I don't have any pension fund and nothing. So the only pension I will have is my investment, so my dividend portfolio, real estate investment, these kind of things. So it's quite important for me to be on top of that, because otherwise I will never retire.
And that's somewhat true now, and unfortunately, as the way it is. But it's interesting because you have quite a bit of experience. You've invested through 2008 crash, and now you've kind of experienced the COVID boom, COVID crash, and all that and everything in between. So you bring a unique perspective in the fact that I think a lot of creators and a lot of people that create content around this space are usually a little bit younger, kind of just started investing. They just started figuring it out, and yeah, and then they decide to share their ideas on YouTube, TikTok, what have you. But you have been sharing your ideas on YouTube and TikTok, and actually have grown a pretty big audience. So tell me about that. Like, what kind of drove you to start putting out some content and recording your strategy and interacting with people just based on investing ideas and strategies?
It all started with TikTok during pandemic. Like I suppose 90% of the TikTok profile started. It was a time where I was working remotely from home. I mean, and more than remotely, I was not even able to exit because it was quarantine here in Dubai. So I needed to stay at home, and when you are at home, there is maybe not that much job. You try to find something to do it, and I was playing with this app. I saw that there was some other creator doing some kind of short video, the TikTok style, and I decided, okay, why not? I can do something too, based on, I don't know, what are my investment, what are dividend. My initial goal was to explain, like to teach about how to start. So the idea was how to open a brokerage account, how to pick up some stocks, stuff like that. And I noticed this kind of topic was become popular because at the same time there was the booming of this, like Robinhood and other brokerage platform. So my channel grow because of that. And after I try to, let's say, move out a little bit from just stock investing, and I was talking about more in general about finance, or sometimes I like a lot to like review some platform, some brokerage platform, or some real estate investment platform, peer-to-peer lending, this kind of thing, anything that can generate some kind of income. I like to review, I like to try new system, and I like to share that on TikTok. And now I start to put them on YouTube, on my newsletter, this kind of things. It becomes some sort of a hobby, of course, because it's not my main job. I do something else for living, but in spare time, I enjoy it. Is something nice. I like to talk about investing with anybody. So it's a way to have a big audience and to share my ideas, and also to get feedback. Why not?
Yeah, I agree with you 100%. And I think, for me, it was a lot of people in my life, whether it was my family or friends, had somewhat of an interest in it, but I wanted to find more people who kind of had the drive and the I guess the deeper interest in it that than I do. And of course, sharing ideas back and forth, I think is really great. You get a lot of feedback. And I think that, there's a lot of brilliant people out there that are on a lot of these social media platforms that you can just interact with at all times. So, and obviously growing your audience kind of helps you get an interaction. So whether it's I've been big on the Twitter Spaces and other things like that lately, and so with that stuff, you get a lot of feedback. You can hear various ideas, people's opinions, and kind of combat them. So I think overall, it's social media has been very great, and I think it's helped me become a better investor. And now I know you told me a little bit before this show that you started this fellowship of the Dividend group, but it's not very big just yet. You're kind of starting it out. So, what is the end goal of that? Is it more so, is it like a Telegram group or something along those lines where you kind of, just have like a group message with people? Tell us a little bit about the fellowship of the Dividend.
Yeah, this started when I joined on Common Stock, which was a surprise for me. So, of course, you're probably aware of it, of course. And, new social network about investing. So, why not? It was interesting. And I saw this possibility to create this private group to talk about different topics. And I'm a dividend person, so I decided, why not? Let's start some kind of private chat group, if we can call like that. I don't know. We can share opinion about dividend stocks, or I periodically, time to time, I post my what will be my dividend for the next month, stuff like that. It's not very popular space, of course, also because common stock is still quite small. But I like sometimes maybe to have some discussion in private. I mean, not publishing a post or having just something for me and other people that have my same point of view. Where I work more is on Telegram, which is not exactly the same channel. Of course, it's two different things. One is on Common Stock. The one on Telegram is more some kind of newsletter. I started after, I don't know, like 6 months I was on TikTok. It was a way to bring people out of TikTok and bring somewhere else. I didn't know where. And this is why I decided to do on Telegram. And I post there my portfolio update. When I do some trades, I show to them, I mean, what I buy, what I sell, stuff like that, or generic topic about how the market is going. I try to do weekly, at least a weekly basis, and I post my portfolio update on monthly basis, which I posted today, by the way. And so yeah, that's it. I like to have from one side the TikTok where I can do some small video, but I cannot express myself as much as I want because it require a very short video. They need to be engaging in some way, which is the hard part. And sometimes our topic, when you speak about finance, it's quite hard to be serious and be engaging at the same time. So I prefer maybe to post something more in detail or more how to say. Uh, I prefer to post something more in depth when I can write. So on Common Stock or on Telegram or stuff like that. I try to use TikTok just to advertise a little bit about myself, my investment style, and that's it. And now I switched, let's say, to YouTube, where I am posting a review of different brokerage platform. This is what I started to do on YouTube, but still, let's say, very small. And let's see how it will go.
That's awesome, man. So yeah, I mean, I think TikTok's interesting. I haven't really been on it that much outside of friends just sending me random ones. But from my understanding, and correct me if I'm wrong, it's a little bit like shorter form videos, right? So it's a little
Yeah.
harder to kind of fit in, with a full long form and stuff like that. You gotta kind of just do those quick hits. And yeah, it's like you said, maybe it's more for like building an audience, and then you can put your long form stuff more on YouTube or writing it out on other platforms too. So like on a newsletter and stuff like that, which I think is great. I mean, the accessibility to all this content where you can like really put it out, I think is just outstanding. There's so many different platforms and a lot of things being improved right now where you can connect with people. And I was able to connect with you all the way out in Dubai, where I'm in America. So I want to ask you about that. So, how is it,
Yeah, sure.
your strategy of being an investor in Dubai? I know you initially said that it wasn't as accessible when you first started in around 2001, when you started in Italy, but now I think that the accessibility to stocks, whether it's in the New York Stock Exchange or in other countries, is pretty open, at least to my understanding. So tell me about that. Are you like mostly investing in European countries or European companies located in Dubai, or do you kind of go in and invest in a lot of the American companies?
As a dividend investor, focus is 99% on United States because United States have a different culture of the dividend. This is what I learned comparing to Europe or even comparing to here to Dubai, which is even worse from some point of view. In United States, management really care about the dividend. They really, how to say, commit to pay the dividend, to pay a growing dividend sometimes. And there are really companies that are paying from more than 50 years. I mean, uh, for sure, dividend is nothing sure. You know that if tomorrow the company will have trouble, they will cut the dividend. It's normal. But in Europe, for example, is different. Every year they will come with a different dividend. Is quite hard to predict what will be your monthly income on long term. And also, it's not some kind of scandal if a company cuts the dividend. While in the United States, a company cut the dividend and will be punished from in the stock market the day after. Will be terrific. What will happen? So I know that if you want to be a dividend investor, you need to look at the United States. There is no much. There's no much else around, in my opinion. Even if we look at the list of companies who are considered dividend aristocrat in United States are hundreds. If you check in Europe, you can count on the finger. So that there is really not that much. And because of that, most of my investment are directed, exposed to the United States. I try to invest also in companies that are international companies, so not that they are only in United States market, because I don't want to put all my net worth in the United States. I mean, I try to diversify, of course, but it's hard to find that in Europe, in my opinion. I have some ETF that are exposed to the European market, mostly on the real estate, honestly. But yeah, my focus is in United States. So, but mostly because of the dividend, I said at this point. About
Now,
Dubai, if I can just one short here, the stock market right here is not very accessible. First of all, company are not free to be 100% controlled by foreigner. So there is always some amount of stock that need to be in the hand of like some government entity or some local person. And also the usual stockbroker I use, for example, Interactive Brokers, or even if we check at Europe, like the Giro or something else, they don't let you trade directly in the stock market here. You need to get some kind of license. It's still quite tricky for investor to access to this market. It's the easiest way is to buy some ETF from, I don't know, BlackRock or something like Vanguard, which is exposed to the market. This is the easiest way. So I'm not investing in the local stocks at all.
I got you. That makes sense. And yeah, so I want to kind of take it back to the point you made about dividend investing in the United States. Now, this is obviously all speculation, so you don't have to, if you don't know the answer, that's perfectly fine. But it's making me think that, in the United States, a big reason why a lot of companies kind of come over is because of the corporate tax, how it's, usually a little bit cheaper here in the United States than it is, maybe abroad in other countries. So, they have that. And then a lot of the upper level and like C suite, like CFOs, CEOs, all that kind of stuff get their partial paycheck in these dividend stocks or get paid by the company stocks. And if they have a dividend, instead of the company necessarily giving them a bigger paycheck, they get these stocks that grow, and then the dividend grows, and so their payments then increase as well. And so, through all that, they're able to kind of get more of a paycheck each month, opposed to maybe necessarily getting just a big salary. So do you kind of think that those are two reasons why dividends is a little bit, maybe bigger in the United States compared to in Europe and other markets, or do you kind of see another reason why?
Uh, for sure, having your management exposed to the dividend and to the stock price so that their payments come from that is probably the best way to try to have a good stock performance. So this is true, and it happens everywhere. Also, from my knowledge, also in Europe, it's widely used for top level management to be rewarded with a paycheck plus some stock option. It's I think is widely used in all international company. Probably in the United States, this become much how to say it's I saw some I saw some situation where, in my opinion, management try to really push so much to increase the stock price, for example, because they are rewarded in stocks. And when these arrive to the point that you endanger the company because you want this short-term return, for example, you are a CEO, you know that maybe you are going to leave the company in the next 5 years, you will find everything you can for push this 5 year in order to get as much as possible. Maybe you will put the company into debts. You don't know what you can do, and after you will just leave and take your big paycheck and leave the mess for the next one. I'm not saying that this is happen all the time. Of course, is something. I mean, things are regulated. You're not acting alone. Like the CEO cannot do whatever they want, apart from some exception. But I think this is the reason why, anyway, in the United States things work differently from a dividend and from a stock price point of view. I mean, in my opinion, management in the United States is much more committed to stock price and dividend. So whatever is paying a higher dividend, make a buyback program, whatever is the decision, I for sure is influenced by the fact that they have a skin in the game, let's say. And this, yeah, is more popular in the United States. So most probably this is one of the reasons for that. I don't know much about the taxation point because I don't know how things work exactly from taxation point of view in income tax in the United States for dividend. I honestly need to document about that, but I don't know if it's more tax efficient. Most probably yes, otherwise they will not do it. But yeah, I think that their commitment is because they have skin in the game, of course.
Gotcha. Now, let's transition a little bit to just dividend investing as a whole. So, I think it's obviously it's great for the investor to have the dividend pay back, but if you think about it, kind of in the broader sense, it's money that's being taken away from potentially being reinvested in the company. Now, when you look at kind of like a dividend stock, do you look at the percentage of the dividend compared to the stock price or revenue, or however that they calculate how much they give you out, and kind of see that as advantageous? Or do you kind of look at, I guess, the overall health of the company, kind of diving into the financials, and then the dividend is just kind of a bonus to you? Or yeah, how do you kind of go about that?
It's I need to balance between these two options because there is no possible to look just at one or the other. You can just look at the dividend yield and find amazing company who pay a very high dividend yield, and you get all excited and you think you found the solution to all your problem. And after you see that the fact that the dividend yield is so high is because the company most probably have some problem financially from financial point of view. So I try always to balance that. I'm not much into company that pay a very low yield, even if they are very profitable company. Think, for example, about Visa and MasterCard. These are two companies I will always like to have in my portfolio. But even if I know that they grow the dividend at quite a high speed, like maybe plus 20% a year, 10%, I mean, something like that, the dividend yield is very low. I consider them more of a growth stock than a dividend stock. So I focus myself about company that have at least 2.5, 3% dividend yield. And if they go higher than 6, I start to get worried, let's say, because there's something in general, there is something not correct. Of course, during pandemic, it was a very emotional moment, and a lot of company arrived with a very high dividend yield because just there was a sell-off without much reason. Because yeah, for example, if you look at airline or hotels, I see the point. You sell off because you understand that this pandemic will bring a problem to people to travel, so less revenue, less profit, probably less dividend, stuff like that. But there was other company which have nothing to do with the sector that tanked also because of this emotional moment, and that moment was the best way to scoop them up and take some very nice dividend yield. So I always try to see one type of analysis I do is I check the dividend yield and the historical dividend yield. So when I see that the yield is going higher than the average, this make me think, of course, it's not the only parameter, but make me think that the company is probably undervalued. If we are talking about, dividend aristocrat, their dividend yield is quite stable with time. So if you see that growing so much, it means the price of the stock is going down, because this is how it works. And this is the moment where maybe it's time to take a look. While I tend not to invest in company which have a dividend yield which is lower than the average, because make me think that probably is overpriced. So this is a type of analysis I do. It's very simple, but it just helped me to do some screening. I take the dividend aristocrat list. I look through that. I check the current yield, the yield on average, the dividend yield grow, and I analyze some of the stock that I mark down some of the stock that I think are interesting, and after that I dig a little bit more into the financials. So I see why the stock is maybe underpriced right now. How is going the revenue grow? How is going the level of debts? It's of course is a deeper analysis that can be done, but this first screening helped me a lot because there are hundreds of interesting company, and I need to in some way make a watch list. So this is let's say my first step.
Yeah, I got you for sure. Yeah, and that all makes sense. So, that's great kind of like insight on your strategy and kind of how you're looking at things and how you analyze, dividends and financials and things like that. But I think it's kind of hard not to mention the overall macro environment. Last month in the United States, we see, I think, around like 8.6 CPI print, massive amounts of inflation in everything from investable assets to home and food and everything like that. And we're kind of seeing a recent dip in asset prices as well. So are you changing up your strategy now? Or are you kind of like preparing yourself for a potential recession? Some people, say that we're in one, whether we are or we aren't isn't part of this discussion. Is just, are you kind of preparing yourself a little bit differently now? As somebody who's kind of, invested through the 2001 .com boom and the 2008 crash, and, you've seen the COVID crash already, and we're seeing kind of another one. Are you changing up your strategy at all? Are you kind of one of those people that, keeps the same strategy no matter what because it's been working for you?
Mostly, I would say that I keep my strategy because anyway, I am investing for long term. I'm not planning to sell any of my stock because of I don't need the money cash at the moment. So at the moment and for the next 5-10 years, I can be quite sure that I will not sell this anything in this portfolio. So I'm not that scared of a recession. I mean, of course, nobody likes to see revenue dropping or your portfolio in red at the end of the month. No, nobody like that. I understand it, but I think that on the long run, the strategy will work for me. The only thing I'm changing a bit is that right now I start again to invest into bonds, especially the one talking about corporate bonds. And because right now that you can get very high yield for them because of course of the interest rate hike or whatever reason, but at this moment the bonds are really low, and the yield you get out of that is quite high. So I'm searching bonds with a expire date in 3, 4, 5 year maximum, and in that case I will feel a bit safe to keep my money there. So I in some way instead to invest all my paycheck, all the money I have into increasing my dividend portfolio, I start to destinate part of this to increase my bond portfolio. This is the only switch I'm doing, but I'm not going like to sell my dividend stocks because I switch to bonds and after to buy them back. I try to do no many trades per month. I don't like to, let's say, micromanagement my portfolio. I let them go. I know, of course, that some stock will perform bad. The good part, if my research was correct, is the way I'm investing was correct, I will probably be able to keep my dividend on the long run. So for the stock price, I'm not so much worried. I hope for the best in the future. Of course, I will prefer that we are not going to a recession. I looking forward to the next earning reports. That I mean, the next 30, 45 days will be interesting to see if this recession fear will translate also in a dropping of revenue, or is just a fear. We don't know. I mean, I'm not an expert on this point, so I need to just stay invested and hope for the best from some point of view. So this is my strategy.
Yeah, no, I like what you said there, and I think like the biggest takeaway for me is that whether you're a macro expert or not, it's very difficult to time the market. And from somebody that's kind of been in, a lot of these ups and downs and swings and what have you, it might just be a little bit easier just to kind of hold on to it. Like maybe you don't time the market, but like you said, if you're buying and you have like a long term outlook, it'll help you rest a little bit easy at night. You won't, necessarily stress over buying a stock when it's maybe $2 higher than the low or something like that.
Yeah,
It's more so that sticking to your strategy because and I think the common theme when I'm doing all these interviews and talking with people is that have your strategy, do your research, and have conviction when you're going through and analyzing these stocks. And through all this, that's great stuff. Is that you just you found something that works for you. Obviously, in bull markets, it looks really good, and in bear markets, it probably doesn't look as good. But that's generally with everything, right? So it's nothing that you can really control. But at the end of the day, you know that this will help you grow your wealth long term, and that's really the end goal that you have. And so yeah, I mean, I think that overall it's great to kind of do that and kind of stick to your guns and stick to your strategy, because I think a lot of people that switch it up, they kind of like tinker around with it, and usually tinkering and moving
yeah.
things and trading a lot doesn't really give you the best results.
If you change the strategy because of fear or because you see things that you don't understand, and maybe you read somewhere or you listen to somebody who has a strategy that look more interesting than your, and you keep switching all the time, I'm quite sure the result will not be amazing. I mean, of course, the market is there is no any safe strategy that work for everybody. I mean, there is no any way to be sure that your investment is 100% the correct one. But how to say, if for me, the company I invest in and also my portfolio, for example, is a low beta portfolio. So in general, of course, when the market is in a bull market, maybe my return are lower, but I'm happy like that. I'm not searching the return of tech stocks. I like to look at people who get rich investing in some startups, but this is not me. I want to sleep at night. This is my pension fund in some way. I cannot risk it in some bet. So I keep my portfolios a low bet, as I said. So when the market is going down, my portfolio in general perform a bit better. Customer staple or this kind of stock, I always perform a bit better during recession or a general market downturn. So in this way, I don't know, I sleep good at night. I don't need to check my portfolio every day. There are times that I didn't check my portfolio for even 2 weeks. I'm happy like that. I'm very happy like that. If I will be every day panicking around plus 10%, minus 10%, I will. My quality of life will be much worse. So I'm happy in this way.
I gotcha. Well, I mean, that makes sense. And I agree with you 100% there too, as well. I honestly, I don't know the last time I checked mine. Yeah, I mean, I like to kind of go through periods of time too, where I'm not really checking and stressing it out, because if I check it on a day to day, I tend to have a little bit more stress with, all right, I'm losing. But in the end, it's just kind of like paper losses, right? Because you could have invested at a low period and it's up, I don't know, 40-50%, and the recent dip, maybe you're not down 40 or not up 40 or 50%, but you're still technically up and in the green. So I think it's not timing the market, it's time in the market. So
Yeah,
I
this is a
think
nice sentence. I
yeah,
think too.
exactly. So
Yeah.
now let's jump into stock investing. So how
Mm.
do you research a stock? Do you kind of, research a stock or a company? Do you kind of go into an industry that you're looking at specifically and then find big companies in there? Or do you kind of look on like a more general basis? Do you look like, strictly just for dividend stocks and then see like, okay, I kind of like this sector here, or I like this one here? How do you kind of find some of these businesses that you invest in?
Uh, as I said, my everything starts from the Dividend Aristocrat list, which is published. I mean, in general, I check every month, every beginning of the month. I download the list, and I focus first on what's considered, let's say, company with at least 10 or 15 years of continuous growing dividend. And from that, I filter the industry. There are different industry, and I pick the one who are more interested. For example, I have some I don't know, conviction from my side. I don't know, but I don't like to invest into financial service, and I don't like to invest into energy, oil and gas, or whatever connected to uh, let's say oil and gas stocks. So I cut them out. I'm sure there are tremendous company over there, but it's my decision not to invest in that. And I search in the list. I see some company who have a yield, as I say, that is higher than the average of the last 4, 5, or 10 years. If I can check up to that, depends from how back I can go. And if I found this kind of stock, after I jump on, for example, I use Seeking Alpha to research my stock. I jump there and I start to look, how is this company, how the revenue are going. We are talking about a business who is growing the revenue, or is a dying business, like I don't know, for example, Altria, which is a stock I own, but it's a stock I recognize is a dying business, and I'm a little bit not sure what to do with this stock, because yeah, the dividend is good, the dividend is safe, but as a company, the revenue are going down. It's not very nice. I always try to find company who have a growing business. Of course, it's more interesting. I check if the company is profitable, because I don't like to invest at all in company. It doesn't matter how much their revenue are growing. If the company at the end of the year don't make profit, I don't like it. I understand that this is not generically correct. I mean, there are a lot of companies who are not able to have a profit, but they will be tremendous profitable in future. But I don't prefer not invest my money in them. I mean, maybe I lose some opportunity, but I prefer to invest a company who make money. And I check the level of debts. I mean, how much in debts is this company? I mean, I don't want that tomorrow. For example, we can talk about AT&T, which is another example of a business that maybe is not growing, maybe steady, but level of debts was crazy, and this is why price was going down and down, because it was clear to everybody that most probably they will have trouble in future. And I'm investing in that. I mean, of course, I'm not happy of my investment in AT&T, how it's going. Yes, I get my dividend. Dividend was cut due to the split of Warner Media. I mean, without entering into that, but yeah, this is other example. Sometimes I do, of course, mistake. I buy stocks that on the paper look good, and maybe my research was not that good. So I always try to do better and better, and check as I say, the debts, revenue growing, and I check what is very important for me, free cash flow, because I need to be sure the dividend is covered. So I don't check much. For example, the payout ratio is not that important to me. It's more important that at the end of the year, free cash flow is more than enough to pay the dividend. Because of course, if this is not the case, I mean, can happen 1 year that you have a lower free cash flow, but on the long run need to be sustainable. Otherwise, this dividend sooner or later will be cut. And cut of the dividend is probably the worst thing that can happen for dividend investor. I mean, if my stock price go down, I don't care that much until I have my paycheck every 3 months. But in the moment you have a dividend cut, and in general, dividend cut come together with a stock price that's going down, is a double, double problem. And this is the worst thing that happened to dividend investor, in my opinion. So the dividend need to be sustainable. This is probably the biggest thing I try to understand with my analysis, which are not that deep. I mean, I'm not a person who spend hours and hours reading reports of one company, analyzing into so much detail. I mean, I have 55 stock in my dividend portfolio. I'm alone. So if I need to research any of them like Warren Buffett does, it will be impossible. So I'm okay with some generic check. I mean, I have some key point I like to look at. I like company which produce something that I use also. I know that technically worth nothing, but how to say, a stupid example, but when I go fast food, I like to go McDonald's because I am shareholder of McDonald's. I'm happy with their food for whatever it is. I mean, I know, but I feel good. I am less happy if I need to go to KFC. I don't want to go to KFC. It's not one of my stock. I'm very, how to say, committed as a shareholder to the company I own, and I try to support them as much as I can. So this is another thing. I don't like to buy stock of a company that I don't like the service or the product they produce.
Yeah, that's interesting because you kind of brought up Warren Buffett already, and you said, you don't really like to research as much as he does, maybe for a company, but you kind of have the same ideology when it comes to stocks, where he says, buy what you use, buy what you own. That's kind of how, he was against Apple initially, and then he kind of looked around and saw everybody had iPhones and things like that. And, then he's like, all right, now I'm going to change my tune and start buying in Apple. So, that's great stuff. And, yeah, so let's get into one of your holdings. Obviously, we're not financial advisors and this is not financial advice. I just like to kind of peel back the curtain here and show everybody, a little bit about your strategy in like one of your holdings. Actually, before we get into one of your holdings specifically, you mentioned that you have, I think, like 55 or 53 dividend stocks in your portfolio. You
Yeah.
know, let's talk about that, because I think that's very interesting. A lot of people, there's different schools of thought where, if you have a lot, not one stock is really going to, help and shoot you up a bunch. But if you have a few, you can have like one that really shoots up well, but a couple that shoots down bad, and it's a little bit more volatile. So, what is kind of your reasoning, and like, why do you structure your portfolio in that way where you have so many stocks?
Um, the question I get the most is because it's a big portfolio by number of stocks is more like, then why just don't buy an ETF that do exactly your strategy and it will be much easier. And this I understand it. I think that uh, I like to do things by myself. I like to do my research. I like to analyze one stock at a time. I like to know how much money I put into different stock, and most important, I like how to reinvest my dividend. I don't make automatic dividend reinvestment. I get my dividend and I decide where to invest this dividend. Maybe in some of company I have that are at the moment I consider that right now underpriced, so it's the moment to build a bit more, or I start invest in some holding that are a smaller holding in the whole portfolio because I don't want each stock to be too big. I like to manage it by myself. The fact that there are many stocks is in some way some sort of diversification because I I understand that they look a lot. 55 is a lot, and I cannot follow each stock how I will follow if I have only one. I understand it, but I consider it like a small ETF from some point of view. This is my small ETF, and so there is a diversification also on companies, on industry and on company. I have more company in the same industry. I have probably almost all industry covered, all the major industry covered, and I don't know, give me a sense of safety. I don't know if this safety is there, but it's something that gives to me this idea. And also I try, this was something I probably not respecting that much if I check my portfolio right now, but when I started I wanted that each holding was lower than the dividend yield of the whole portfolio. With the, I had some kind of worst case scenario that if a company go bankrupt tomorrow, one of the company in my portfolio go bankrupt tomorrow, with 1 year of dividend yield, I covered my loss. This is, of course, it's not correct. It's not something that, how to say, it's not a proper financial advice to do like that, of course. But it make me feel safe in some way to know that even if something very bad happened to one of this company, nothing will happen to my money. Of course, in case of recession or in case of an industry wide problem, there will be not only one company suffering, will be many of them. But sometimes there are companies who can fall to zero from one day to another because of some scandals, something that can happen. We had a lot of situation like that in the past, so I want my money widely spread between many of them.
I gotcha. That makes sense. So the diversification, I think, is really good. When you kind of grow your wealth, right? Because I think diversification kind of helps you keep your wealth and grow it as well. Whereas maybe like specializing or kind of focusing on one industry or one company or something is a way that you can really grow really quickly, but is also very risky. So it depends on the way you want
Mm.
your strategy to go, or and other things like that. But I think at the end of the day, if you want to keep growing slow and steady for the long term, even Warren Buffett suggests just investing in the S&P 500, index fund. So that's obviously proves to be pretty good in its own right as well. So I mentioned it before, but let's get into one of your holdings. So I'd like to get into General Mills. How did you find this stock? Did you kind of find it, along the lines of, how you described before?
Uh,
And what is it? What do you like about it? And yeah, so tell me about General Mills.
It's I found it. I think I started my position in General Mills something like 2017 or 2016, something like that. I don't remember exactly. Of course, I averaged down during time. I mean, I didn't book only one time. This is another style of investment I do. I try to do dollar cost averaging when I start a position. Anyway, yes, I found in the list of the Dividend Aristocrat company. I checked the company, the brand they have, and I was very, very happy at the beginning with General Mills. But after, if you know a little bit about the stock, it has a period, especially like 2018, 2019, when the stock was down quite a lot. Also because they paused the dividend increase, which is something very bad for me. I mean, I was not happy because I found this company, I liked it. All the numbers were okay to me. Revenue, okay, revenue was not. It's an industry that revenue is not growing so much unless they can grow only with acquisition, because they have a portfolio of brands, and customer stable company. The revenue are quite predictable. You can increase. Low one digit per year, no more. I mean, it's already going to a more than 5% increase will be a bit strange. So, but the company made a big acquisition, and they started to invest into the food for pets. I don't know exactly how it's called, pet food. They purchased a brand called Blue Buffalo in was 2018, 2019, something like that. And the market didn't like much at the beginning because very expensive purchase. You need to stop the dividend increase in order to finance also this. I was not happy with this company, but anyway, for my strategy was, okay, they post the dividend increase, but they're still paying the dividend. Is an investment for the future because they're increasing their portfolio of brand. So I'm happy in general when a company do acquisition to increase their portfolio, especially if you are talking about customer staple. I'm happy about that, and it turned out good because from 2019 up to now, price of the stock almost double. So I mean, this is an example of where I said before, I don't change my strategy because the price of stock is going down. I mean, I understand there was fear about something new. The company is doing an acquisition, is investing a lot of money, even is posing a dividend, which is bad. I mean, for a lot of dividend investor, you expect this dividend to grow at least to cover inflation in some way, but no. And but if a company stop the dividend for a reason that I believe in too, like, okay, we stopped because we need a little bit more money for a while. We don't want to increase our debts too much. We want to save some money because we are doing acquisition, and this will turn out good. And I mean, I see the point, and I was sticking with the company. I invested more when it was down. I averaged down. Now is one of my biggest positions, General Mills. So I'm quite happy with that. And again, I started searching on the Dividend Aristocrat list. This is where, for me, everything started, because sometimes I come up with a company from zero, like maybe I saw something or I read something, I see some YouTube or somebody talking about a stock, and in that case I go check it. But it's very important for me every month to run through the Dividend Aristocrat list and see how the company are moving, if there is something that go in buying territory, and in that moment I start my research. This is how I do.
Gotcha. Now, what would change your overall thesis on General Mills to kind of make you change, your position and maybe sell off?
Uh, to be honest, of this portfolio, I never sold any stock right now. I mean, I have only one that deserves to be sold, but I keep it there just because to remind me that I need to think more when I invest. It's a stock that is down like 70%. Thanks God, it was a very small investment, and it has all the red flag, which is supposed to tell me don't invest in this company, but I did it, and now I keep it there in order to remind every time that don't make like like that one. So what need the General Mills do? Now, for example, they started again to increase the dividend. This is a great news. If I will see during, for example, earnings report that we are talking about the fact that revenue are going down, I will monitor maybe for 1, 2, 3 quarters, something like that. If I see that they are not keeping up with revenues, even after such acquisition. So, you invest money, you're supposed to have bigger revenue because you bought a big brand that is now part of your portfolio of brand. And no matter that revenue are going down, I know that this company showed already that dividend will be one of the first thing to go. And this I cannot accept. My portfolio need to bring income every month. This is the goal of my portfolio. So if I understand that the dividend is not safe, is the moment I will think about selling. It's very hard for me to sell a company. As I said, I never did it right now in this portfolio. I did before other type of portfolio I had. It's very hard, especially if we are talking about very big company and that you believe that they are like blue chip company. You believe that at the end they will turn around their business in some way. It's but the idea, what I cannot accept right now is the idea that my dividend will be cut or even stopped at all. So this will be it will be hard to be able to sell exactly before I discovered that, because there are so many people looking into, and I will not be the first one to understand it. But I think already that falling revenue, especially if the whole industry is maybe growing, but this company in the same industry the revenue are falling comparing to their peers, this is the major flag I will put a flag on this company. I will keep a look for 2, 3 quarters. If I see that the dividend is unsustainable, I will probably sell it because anyways I have a good profit, and why I need to lose it? So I will move somewhere else this money.
Gotcha. And that all makes sense. So I think that's a great insight onto, how you think about companies and General Mills specifically, kind of diving into those examples. And now, you've been very generous with your time. So we're going to wrap it up with 2 final questions. So for somebody who's just getting started, what is the, advice that you give them for their first step to kind of get started in investing?
For me, the first step in investing, if you are young, you don't know much about investing, don't focus on picking stocks. Focus on investing on ETF, especially like S&P 500 ETF or Nasdaq Triple Q, something like that. But what is the most important part, in my opinion, is to find your monthly budget. Find a number that you are sure you can invest every month. Doesn't matter, it's $50, $100, $500. Doesn't matter. But find this number that you are confident you can invest every month out of your salary, of your expenses, and be constant every month. Beginning of the month, deploy this money into your brokerage account. Buy this S&P 500 ETFs with dollar cost averaging is not important. And in the meantime, start to study how stock work. Maybe you will get curious, so you will be interested in studying stock, and sooner or later, maybe you will jump in selecting stock by yourself. But what I found the most difficult part is to be consistent and to respect your budget. This is what people usually cannot do. At the end, this month I prefer to, I don't know, go out to dinner one time more, and this month I will not invest. Or this is the part that you need to fight. You need to fight against distraction from your journey, from your investment journey, and you need to be consistent with your plan. So whatever is your budget, no matter how small it is, just be consistent. Do it at least for 1 year. Every beginning of the month, take this money before you spend in some useless subscription over that I'm sure we are all. This is a big problem of subscription. I don't know how many I have, but try to invest before you start to spend it, and do it for 1 year. This is already, you are doing better than so much people out there. I mean, investing $500 a month in the S&P 500 for 1 year, you're already doing much better than the average people out there. So my advice is to start with that. Don't focus on stock picking, because especially at beginning, stock picking is hard, and having a big loss will make you drop it, like I did when if instead of starting with trading, I was starting with dividend investing. Right now, I don't know how happy I will be, but I'm sure the difference will be tremendous. So
That's
yeah.
awesome stuff. And so, yeah, you answered both my questions. Great advice on how to get started, and kind of taking that first step to get over the hump, maybe that mental barrier that a lot of people have to get started in investing. I think in the end, the longer your outlook, the best time to start investing was, years ago, but the second best time is today. So whenever you can kind of get started and do all that, I think your future self would be definitely thanking you.
Yeah.
And
There was a
yeah,
sentence who say, I never heard any investor say that I started too early. I never heard this. So today is already better than tomorrow. So start today if you can. This is my advice.
yeah, for sure. All right, Luca, thank you so much. Why don't you tell everybody, what you got going on and where they can find you and your content?
You can find me with this screen name on Common Stock, which is the place I use the most, to share my idea or to write post on, let's say, on a daily basis. Otherwise, my YouTube channel or my TikTok channel is, let's say, the place where I investing my time the most. Right now, I'm more into YouTube. I would like to grow more on YouTube because it's more in line with the type of content I want to bring. So this will be my effort for the next months, years. Let's see. So you can find me there, and anyway, on Common Stock there are all my links, and it will be easy to find me.
For sure. And he's stock.owl for those who are just listening on the audio. And yeah, Luca, thank you so much. And it was a great
Welcome. Thank you.
conversation. I
Yeah,
think,
it was great. I
yeah,
like it a lot. Thank you,
yeah,
Brandon.
yeah. Thank you so much. All right. And that's it
Bye.
for this Sunday Scary Stock Talk podcast.